Right now, you can get up to 15 free stocks, each stock potentially valued up to $2,000 a share by using my link in the description below. Right now, you could also earn a 5.1% APY on your uninvested cash on Moomoo. So go ahead and check out Moomoo. I'll put a link to them in the description below. Now let's get right into today's video here. So today I want to talk about the bull put spread on steroids. So this can be a very useful option strategy, as we'll see here. So what I'm first going to do here is I'm first going to start with a regular bull put spread. So for today's video, I'm going to be using ticker symbol DKNG, DraftKings, to take you guys through this demo. Again, everything I'm showing you here in this video is just an example. These are not official alerts or trades I'm taking here. So here we are on DraftKings. And so the first thing we're going to do is we're going to go into the options here for this stock, right? So you go to the options for whatever stock you want to use this strategy on. And so the first thing we want to do here is select an appropriate expiration date here. And again, that really depends on your own personal goals, your time frame, when you see the stock hitting the price you need it to hit, things like that. But for today's video, I'm just going to leave the expiration date as it is, December 22nd, 3 days out from expiring. Now, as the name suggests, bull put spread, that tells us this is a bullish strategy, meaning we're going to want the price of the stock to go up. And then this is going to be a strategy using puts, hence the name bull put spread. So what I'm going to do here is I'm going to switch over to puts here. And first, I'm going to switch over to sell here. Okay, so we're going to first sell a put. So here, in my opinion, is the hardest part to this entire strategy. What you want to do here, once you're at this stage, you want to determine what price you believe the stock will be above at our expiration date. So for my example here, I'd want to try and determine what price I believe DraftKings will be above on December 22nd when these options expire. And of course, you're going to have to do some sort of analysis, technical analysis, fundamental analysis. You'll have to do some sort of analysis. But you want to try and determine that price as close to you can get to that price, right? And so again, since this is a bullish strategy, generally we should believe it's, probably going to be, higher than what the current price is. So let's just pretend that I think DraftKings, on December 22nd, that expiration, let's say I think DraftKings will be above 36.50, right? And so the first thing we want to do here then, so we want to sell a put at that strike. So we want to find the strike that has that price that we just determined the stock will be above at expiration, or the closest price to that, right? And so here's 36.50. So I would start by selling a put here. Then I want to switch over to buy, because now we need to buy a put here. And this is a little bit easier. We want to buy a put that just has a lower strike than the strike of the put that we're selling. And you can kind of experiment to see, how your P&L changes, how, depending on how much further away you get from the put you're selling. But let's just say I want to buy the put at the 35.50 strike. So I would go ahead and select that there, right? So this is a bull put spread here. We're going to be entering for a credit, as you can see for this example, maybe around $50 or so. And of course, since we're getting paid a credit, that means we're going to have to put up collateral. For this example, we'd have to put up $100 in collateral here. And so let's quickly take a look visually at what this looks like. So I'm going to go over to Option Strat here. I'll put a link to Option Strat in the description below. A really great options visualization tool. You should definitely be using this if you're trading options. So I'm just going to go to puts here. Let's go over to the stock we're using for today's demo, DraftKings. And then let's see. So again, we first, selected an appropriate expiration date. So I selected December 22nd. we said, okay, first we need to try and determine what price we believe the stock will be above at expiration. I said, let's just pretend I believe it'll be above 36.50. So we said we need to first start by selling a put at that strike price then. And then I said, okay, we also need to buy a put with a lower strike than the strike of the put that we're selling. So I just selected the 35.50 strike. So again, this is a bull put spread. As you can see here, option strat tells us that. For this example, again, we're entering for around $56 in credit. We're putting up $100 in collateral. Max loss is going to be our collateral minus our credit. So 100 minus 56, 44. Max profit is the credit we're receiving. If you have the premium version of option strat, they give us the chance of profit. So according to option strat, our chance of profit here is 46%. And then we have our break even here. So what is the problem with this, or what could potentially be a problem with this that people might have? One big problem is that our profit is capped here, right? Our max profit here is limited to the credit we received. And that's going to happen at expiration if the share price is at the strike of the put we sold or above. So as we can see here, right, if it's at the strike of the put that we sold or higher, we're still only going to make the credit we received. So it doesn't matter how much higher DraftKings goes, we're still only going to make $54 or so. Right? And what if DraftKings has a really great week and explodes, 10, 15%? Well, it doesn't matter. You're still going to only make the credit you receive. So you could potentially be losing out on a lot of gains there. So how do we fix this? How do we amp this bull put spread up? Very simple fix to this here. So if we go back here to Robinhood, we already have our bull put spread set up here. So we're still going to set up a regular bull put spread here. But now what we want to do, so we want to use some of this credit that we're receiving, which again is around $50, $54. We want to use some of that credit to finance another option that can help us in the event that the stock really moves up, really goes higher. Because again, after all, this is a bullish strategy here. And so what we can do is we can use some of this credit we're receiving and we can buy a call with it. So what we're going to do here is we're going to buy a call that costs less than the credit we're receiving. So we still want to enter for a credit here. So let's say, for example, I buy the call at the 37.50 strike. So this only costs $18. That's less than the credit we're receiving. So we're still going to be entering for a credit. But now remember, a call is also a bullish strategy. And remember, a call has infinite upside potential. And so now you can already see what's going to potentially happen here. So let's visually take a look at what this looks like now. So I'm going to go back to a new tab in Option Strat. I'm going to go to regular calls here. And we're going to go again over to DKNG. Let's set up our regular call here, our regular bull put spread here very quickly. So again, we sold a put at 36.50 since we believe DraftKings will be above that at expiration. Then I said, okay, well, we also need to buy a put with a lower strike. So we said 35.50. And then finally now I said, now we also want to buy a call that costs less than the credit we're receiving. So we're going to add a call. And I just selected the one at the 37.50 strike. Again, this is just an example here, right? Just something I'm kind of coming up with here on the spot. Not an actual trade I'm going to take or anything like that. So this is what this trade looks like now. So again, remember, right, over here with the regular bull put spread, what did we say? We said, hey, if DraftKings has a really great week and goes up, let's say 16%, we're still only going to make the credit we're receiving. We're still only going to make $50 here. But now what happens over here if it goes up 16%? We're going to make a lot more than the credit than we're receiving, right? We're going to make $430. And the higher it goes, the more we're going to continue to make. So we still have a bull put spread here, but we're also adding a call. So we're still entering for a credit. Credit is a little bit less. So that makes our max loss a little bit more, right? Our max loss went from about, $48 to $66. But look at our max profit. Our max profit goes from $52 to infinite now, right? So if you love using bull put spreads, but you hate the fact that the profit is capped, you could just add a call out like this. And basically now you have a bull put spread that is on steroids that can make you still an infinite amount of money on the upside. So anyways, if you have any questions, feel free to leave them in the comment section below. Check out the Discord, a link to that in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.